Hey, very good morning, everybody. Welcome to the Flow Show. It's Wednesday. I think it's Wednesday. Yeah, it is Wednesday. Wednesday, 7th of February. Off we go again. Good morning, K-Man. Denying my Chinese New Year's holiday request.
Rejected. Good morning.
Yeah.
Morning, everybody. Morning, Brian. Yeah, today looks like a bit of a snoozer to start the day, right?
Yeah. Well, go and give it the kiss of death, why don't you? Yeah. No, we've got a few moves going on to talk about. So a bit of action. Bit of a reversal of what we've seen in the last couple of days due to all that repricing that we got post-Fed and FOMC, but we'll look at all those price moves shortly. Right, let's get cracking. We mentioned yesterday that President Xi in China was going to have discussions with financial regulators. Those discussions have turned into the axe falling on certain people because the head of the China Securities Regulatory Commission, that's the mob who were issuing comments that they will crack down on market manipulation and whatnot. Well, their head has been given the sack and replaced. So Xi not wasting time in wielding the sword, shall we say. There was a piece out overnight in the SCMP, the South China Morning Post, which can be a bit of a mouthpiece. This was an analyst piece saying that China could boost demand and ease deflation with cash payments, aka helicopter money. That is one of the big bazookas they can use. Just save faffing around and just give tons of cash to the population. The analysts say that a direct cash injection would encourage businesses to expand and boost activity, but they say that at the moment, policymakers show no real signs of interest in doing that. So that is true. We know that from the measures they are currently looking at, but it is one of the pieces of ammunition they have in the toolbox. Just to go flat out, here's some cash and get things boosted from there. We need to know that Chinese New Year starts on Saturday. Rand's already moaning about it because the New Year for those guys runs for 15 to 16 days. So market stuff won't be happening over that period, but they will still be keeping an eye on what's going on in markets elsewhere. Otherwise, things will go a little quiet from that side. Just need to keep an eye on that if you trade gold, because gold can be well in demand as New Year gifts. Can put a little bit of a bid in gold around this time of year, maybe part of what's holding it up. So need to watch gold markets when they enter their new year. On the reserves front, China has increased its gold reserves in January for the 15th month running. So they keep hoovering it up over there. On to some data in Kiwi land. We've got some jobs and wages numbers there. Employment was up 0.4%, so better than expected. The unemployment rate went up by a pip, but not as much as expected. So 4% versus 4.3% expected. A little bit of a dip in the participation rate as well. So that adds into the mix too. Labour costs looking a little bit sticky year on year for Q4. Coming in at 3.9. We're expected to dip to 3.8%. On the quarter, though, higher than expected, 1%. So a bit of wage pressure there for New Zealand, which adds to what we've seen on the inflation front as well. It might just keep these guys just sounding a bit more undovish at their next monetary policy meeting. Definitely another case of jobs not done on inflation and probably not looking to shut the door on hikes, further hikes either. So a bit of data there. Over at the Riksbank, we had their minutes out where you get a bit of a deeper insight into who said what. Governor Theeden said there's clear signs we may be on the way into a new policy phase. Floden said a rate cut in Q2 or Q3 seems increasingly reasonable. Janssen said the first cut in May or June more realistic, so pretty much in that Q2, Q3 ballpark as well. Any pickings elsewise from the Riksbank's, Kate?
No, no, it's sort of in line with what they said before, right? That they could start to cut, and yeah, it does look like a lot of the central banks are now sending us to my preferred zone for everything starting to bubble, and that's Q2. Q2 this year is, in my opinion, going still to be a period where all of them are probably going to at least indicate or starting to move, and we are heading into a very, very interesting second quarter of this year. That's my opinion right now, and they are basically confirming it, right? And that's what most central banks are doing. Okay, with the occasional fight back, perhaps a little bit longer, but it's like a global theme. They're all walking hand in hand. Somebody has written the central bank handbook, and they are reading page after page out of it.
Yeah, very much so. And so we have to think where we're at with central bank. So if you think the Fed, ECB, they even to some extent the BOE, they've all pretty much closed the door on further hikes. Fed and ECB in particular taking that sort of language out their statements and whatnot. Everyone's moving towards cuts. No one is there yet. No one seems to be cutting early. There are a few central banks like the RBA, the RBNZ, maybe the couple of others who are still got the door ajar for hikes, but it's a low possibility. So where we are with the market is that the market knows what's coming now. So what's going to move prices? If all the expectation is roughly priced in, although there's still some overly dovish assets showing overly dovish outcomes. What's going to need to happen to change that? Well, it's going to be obviously inflation turning back up, growth maybe getting a bit hotter, things like wages heating up as well. If that happens, that's going to bring the risk of them delaying cuts or not cutting as much, and potentially moving over to the hike side. So that's what's needed to change the direction for the markets at the moment, and that's looking at the moment a low risk possibility, but we never rule anything out in trading. But yeah, all the central banks seem to be singing off the same hymn sheet for the moment. Over at the BOE, the archdove Dingra, who was the only one voting for cuts last week, has urged the BOE not to take a risk with the UK economy, hence why she wants to start cutting now. It says inflation has been tamed and now is the time to cut interest rates. I read her speech and she made a couple of points. One thing about wages, saying that UK has always had quite a high level of wages, 4 or 5% mark, so it's not too bad by historical norms that wages currently stood up around that 6% mark. But overall, still a bit more dovish than where the BOE are generally on that. BOE's Breeden says that she might have become less concerned that rates might need to be tightened further. She mentions wages as well, saying pay is still several points stronger than their CPI goal. Over to the data. Reality came back to Germany after that bumper factory orders yesterday. Industrial production dropping 1.6% on the month there versus a minus 0.4% expected. Year-on-year number as well, minus 3.13%, not as bad as last month, but still another negative. So back down with a bump there. Spain as well, not posting overly hot numbers there on their industrial production year-on-year, down 0.2% there. The non-seasonally adjusted number was down 4% versus a prior up 1%. So a little bit of weakness coming in still. ECB's Wojcik says ECB shouldn't rush to start its rate cutting cycle. It's important for its credibility to be right with rate cuts. There's still quite a lot of resilience in services, inflation and wages. The equilibrium of ECB interest rates are likely to now be higher than it looked some years ago. I'm going to touch on that in a moment, because BOE's Macklin has said something on the neutral rates as well, or equilibrium rates. He was out yesterday saying that the discussion about future policy is shifting from whether monetary policy is restrictive enough to how long to maintain the current stance. He says the path to 2% inflation is likely to be slow. We are not working to a timetable when it comes to rate cuts, and the challenge that worries him most is the persistence of inflation. Now, he said, looking ahead, the neutral interest rate will probably be a bit higher than the 2 to 3% range. Now, I just want to highlight this quickly because we heard, as I said, Wojcik said the same thing as well, likely to be higher than some years ago. The neutral rate, equilibrium rate, R star, whatever the propellers want to call it, is the interest rate level at which everything is well balanced. So that means when the economy is, ticking along nicely, inflation's in the right place, there's a rate level that they assign to that that supposedly keeps everything in check. So like Goldilocks and the porridge, not too hot, not too cold, just right. Most neutral rate levels were around about 2%, 2.5% going back in time. A lot of central banks now saying that neutral rate is going to be higher. The rule of thumb probably a year or so ago was that it may be around 2.5% to 3%. It could be up. It could be up higher, maybe 4%. Why is that important? Because that will determine how far central banks cut rates when they start cutting. So, some in the market were expecting the Fed to cut 150 basis points. Well, that would take them well down, probably to the low end of where they may see this neutral rate. If you think the ECB 4.5%, if they see an equilibrium of 4%, they're not going to be cutting too far. So it's going to be an important metric to add into rate cut expectations as to where the central banks see that level and where the market sees that level. Kay, what are your thoughts on this? Now we're just starting to get a few more comments on the neutral rate.
Yeah, I agree. They're going to be higher than before, just because inflation is probably not going to fall flat to zero again, unless there's some big developments again in sales or technical advances and things like that. Some people said that AI may be an anti-inflation event as well, but I still have to see it. Yeah, we used to in the good old days, we used to run actually or accept that the neutral rate should be somewhere above CPI. But that we have seen when completely out of the window after the global financial crisis, that kind of idea and global acceptance. So yeah, I can imagine it's a bit higher now than it was before, because just inflation is probably not going to collapse back to zero or going into deflation for the next foreseeable future at least. So it's going to be important, especially for the short end of the yields market, because as we know, the 2-year is probably where the market is closest to where the Fed funds are expected to go, and that's going to affect those ones the most. And then you will look at everything which is longer term to have a very good idea on how the market will price economies, and that will be very data dependent as well. Besides the inflation consideration of the of the monetary policy going forward, and to get to the neutral rate.
Yeah, agree with that, mate. Agree with that. Right, moving on to the Fed. Fed's Mester expects the Fed to gain confidence to cut later this year, using that same phrase, confidence, in a language. It says when the Fed cuts rates, it will likely be at a gradual pace. But if inflation doesn't fall, the Fed can maintain current policy. So not talking about hiking if inflation doesn't fall, but just staying as is. Inflation must be moving sustainably lower to open the door to rate cuts. Still expects 3 rate cuts this year, and says it's not necessary to move only at meetings with forecasts. Also on the QT subject, said there's no urgency to slow the pace of the balance sheet reduction now. Fed's Harker says he sees real progress on getting inflation back to 2%, and the economy is on the right track for a soft landing. Cash and Carry was out again as well, saying we're not all the way there yet on inflation, and stepping into the political realm, sort of, saying we do not think about politics or the election when we set interest rates. Yellen has a few warnings, Treasury Secretary Yellen has a few warnings about property markets, real estate markets. So she has concerns about commercial real estate and that many small banks have commercial property concentration. Says properties in some cities are of special concern, and that they're monitoring the current banking stresses carefully. All sounds like what we've been hearing recently to do with New York Bank Corp and all the rest of it, that maybe there is a few stresses brewing there, more so than we knew about previously, just based on reading through her comments. The New York Fed had one of its surveys out, or one of its reports out, and they're seeing signs of trouble in auto borrowing. So part of what's happening with overall debt levels rising. There's a few little stresses popping up here and there, as we spoke yesterday, from that survey, banking survey from the Fed, that credit conditions or credit lending standards have tightened up, banks being a bit more picky who they lend to. So there's all these things are just feeding in a bit into parts of the financial markets or the borrowing lending area. The UAW, United Auto Workers, that mob who got all those big juicy pay rises for auto workers last year, they've now signed up the majority of workers at a Volkswagen plant in the US. They're looking to expand their membership numbers significantly, taking over quite a significant portion of auto workers there. Why that's important? Well, we saw what happened last year: strikes, pay deals, bumper pay deals, auto firms being forced to get those wages up. Well, the more members the UAW get under their belt, then the more leverage they'll have on those also looking for pay rises, and not just for last year, but it will happen this year and the years after. They become a big labour power. So just something to monitor going forward. Kay, that's all I've got. Anything you've got you want to bring to our attention?
What was it this morning?
Oh, I didn't mention the Swiss stuff.
Yeah, the Swiss reserves went up, but it's still not really a very big number, and I guess there's a bit of revaluation there as well, from the assets, because we've seen the numbers out for December. They were relatively flat, but then in January the Swiss franc weakened. So it's not a lot, but you can put most of it, I guess, down to revaluations. But the positive sign, and that's what the market seems to want to trade now as well, and is happy to trade now as well, is that it's not going down anymore. The S&P has clearly stopped buying Swiss franc for now, as Jordan already indicated, and so the Swiss is, I would say, very gradually, in the process of weakening a bit, and now the rest will likely depend on the dollar. It does look like Swiss crosses as well have woken up finally, because we're seeing in stuff like sterling Swiss, Canada Swiss, which quite a few people in our room are in as well, is making a bit of headway. So there's positive signs for those who are short Swiss franc, and at least from that side, from the reserve side, we don't need to worry about too much right now. But for the rest, no. Schnabel says patient. No. I haven't seen much else really to talk about. Nothing market moving anyway, apart from some opinions here and there.
Yeah, we got a bit of a quiet calendar today as well. Got NBA numbers, just to keep an eye on the housing stuff going on. Got a couple of other speakers. Other than that, trade balance later on from the US and Canada, and that's it. So not a lot to get our teeth stuck into as far as the data is concerned. Ali, you've put up a saying from Nabi Hyatt, talking about there are 4 kinds of bets: good bets, bad bets, bets that you win, and bets that you lose. I'm not a big fan of that saying you've got there regards to trading. For one thing, we don't bet, we trade. Secondly, the only good trade is the ones that you win. Everything else is a bad trade, as far as I'm concerned. So, you don't win a bad trade. You have a bad trade, it's a bad trade. What we do have is control over whether a bad trade, I should say, is just bad or really bad. That's something we can manage. That's why you can have lots of bad trades, but if they're contained, then the good trades outweigh them. That's when you look at your win-loss ratio. I've got a win-loss ratio of about 51%, but that 51% makes more than the 49% that lose. Hence why I managed to stay in this game. So, yeah, it's trading is not like betting. Okay, you bet, it's out of our hands, which is a bit like trading, but we're in control over how much we can want to lose, and we can manage the trade as we go along. You can't manage a bet as it goes along if you're talking something like fixed odds betting. You put your money down, that's your money gone, or you get it back. At least with trading, you have a chance to reduce how much you're risking. So yeah, not. I get the sentiment, but I'm not overly keen on that rule there, or that analogy there. But anyway, back to markets. What's going on? Well, I was looking at gold, as you can see, just to see if there's been any movement. We had some headlines. This Hamas Israel deal, no deal thing has been batted around over the last few days. First proposals were knocked back by Hamas, then they proposed some which got knocked back, and now they've proposed some more. So if they do get a resolution, keep an eye on gold, because that rallied quite a lot on the original risk back in October when the unfortunate event happened. That's what really kicked it off, and it kept going since. So if there is a full resolution over there, which we hope will happen quickly, then maybe we see gold finally coming down to lower levels, maybe breaking through the support here. But as I said, with China on its holidays next week, geopolitical news may be a bit more of a driver than perhaps it has been of late. So as I say, keep an eye on that one. As for the rest, well, let's start with cable. It had its nice little holiday. Decided to go for a little trip down to 125. Ate some donuts, some ice cream, and now it's back home in the box, 126, and sailing pretty at the moment above the big figure again. So this, I wouldn't call it a fake out. It reacted to what came from the FOMC and the NFP. It reacted to the repricing of Fed cut expectations. And now it's got back to normal business, and looks like it might be going back to the middle of the range again. And we have to do all the hard work again. Think of it a bit like the extensions we've had above 128, where we have a little mooch up there, a little break, run a few stops, get a few people shaken out, and then it runs out of puff and then everyone scrambles to get back in again. It's a pretty similar picture around a lot of the pairs. Aussie dollar, another one. Oh. Had a move under my special zone, came up, resistance, broke it. We haven't yet got through the top of it, and we're back down again now. But it's given up this move down here. Very significant price action that I've been talking about. If you want to pick bottoms, look for the right pattern. Low, new low, old low holds. Gives it a bit of a base to spring up. Can we go all the way back up here? That remains to be seen, but it's still looking a bit weaker than the others. We have got a bit of geopolitics running in the background for this one as well. A journalist got suspended death sentence in China, an Aussie journalist. So that might kick off another bit of a political spat between those guys, where relations had just been looking to improve recently. Let's see if they deteriorate further. That might add a bit of more pressure onto the shoulders of the Aussie here. But at the moment, technically, we're messing around with this zone. It needs to break above it. If we can't, then it does keep the downside in play, at least in the short term. Dollar yen, pretty much following what's happened in yields, weakened off the high. It had a few knocks up here. I thought we might be building for a bit of a break, but no, the level remains strong around the 148.80s. And then with US yields crapping out a bit or failing at 420, naturally dollar yen falls down, but not going too far, this one at the moment. Kay, still, this one's looking a bit boring at the moment.
Ranges for now. There's a bit of activity on both sides apparently. What I suspected yesterday, I said in the room, I said there's maybe a bit of exporter offers up there, seems to find confirmation. You just trade the ranges, and when the yields trade ranges, dollar yen trade ranges as well. I think a lot of people were trying when it was hanging on there, were trying to perhaps go for a break or at least try to get into the 149s. Didn't work, comes back below 148.5, 40, and then people need to get out of it, and that's I guess what happened. But there's very little reason to go really short dollar yen as well, unless it is for a range trade. So get nothing bad or different, I would say, for the dollar. I still think we are in we're in a range there, and then it all comes back to the question: if you're short dollar yen, or are you willing to keep it going? I'd say if you're short dollar yen and it goes 100 pips in your favor, it's perhaps time to at least take some off. And if it goes up, you've got the level up there, which is really stubborn. And then equally, if you're long, you can take your profits, or at least bits and pieces of it, and then look on to the next opportunity, you know?
Yeah, very much. And it's pretty much as I've been saying, you know, a lot of people get a bit excited when you get, particularly what we saw in, the likes of cable and euro dollar, where you get a decent breakdown, you get a big move, and people think, oh, it's going to keep going, it's going to keep going, it's going to keep going. And you have to look at the context of the move. You know, as I said all week, what have we done here? What have we been trading here? We haven't been trading the Fed suddenly turning hawkish and touting hikes. It's just been a timeline change. Some of the markets still overly dovish, just changing their timeline for these cuts. That's the reprice we've had. So does it mean the euro is going to collapse? No. Does it mean the dollar is going to go another 500 pips over the next few sessions? No. But then we have to look forward. And looking forward, the US at the moment is shining above the other economies. So that is going to keep the dollar at least well bid. It's going to make, pairs like euro dollar moving higher a bit more tougher. Doesn't mean we can't get back in the range and mooch around, but I'm not expecting any huge moves to come. I would have liked to have got down to 107. I would have liked 125 in cable, but that wasn't to be. Such is life. But I'm not. We could get a grind lower. This trend could continue through the year if the data keeps coming out, and it's a slow move lower and lower and lower. But I'm not expecting any big collapses in these sorts of pairs unless the data goes with it. Euro sterling is given up, tapped the 85.70 level, and now we're back down testing the 85.20 level. As I've been saying, I don't like it when a price comes back to a level so quickly. It usually spells trouble. So maybe we'll get a move down to 85s if we get through this traffic here. But this is euro sterling, and it can go sideways long enough to test all our patience. So we could be having the same conversation in 2 weeks' time, and still nothing's changed. But for now, I'm getting a bit more neutral down here as opposed to bullish. I'm still thinking of adding in to my longs back against this level because it is still a big level and we haven't really tested it yet. But I am mindful of the pressure this is under, this downtrend that we're in, and that we keep coming down here. So I'm more and more, even though I want to try longs, I'm more and more thinking about looking at what happens if we break and maybe flipping short if we get through sort of 84.80-ish. Because if we do break a big level like this, then it can have a bit of punch with it. And a bit like the S&P in its break, you know, you can see this area, big, huge, old historical area. And when you get the breaks, they tend to be quite significant. So that's what I would look to catch if one should happen. But let's see, a lot to go on. Mark wants to have a look at WTI. Let's have a quick butchers. WTI, let's come in a little bit. Not an awful lot going on in this one. Still surprisingly low, given all the geopolitical risk, although it is contained, as we've been saying for a while now. The demand side of things, well, we've seen a bit of improvement in things like the PMIs, but then you get shocking numbers out of Germany and industrial production and the like, and you wonder where is the demand coming from oil at the moment. Until then, we look pretty range bound, I should say, on this one, up into that 80 buck handle, down into, you know, the low 70s, this area here around in the 67, 68s, where Bidden has all his bids lined up to refill the SPR and all that sort of stuff. I really don't see any kickers here as to why we should start shooting up unless data really starts taking off. Obviously, you can probably you can sort of tie oil markets to what's happening in China as well. You know, weakness over there isn't good for commodities, although they're probably backdooring their oil supplies from Russia anyway, so it makes no difference. Mark, what you got anything specific you're looking at in this one for oil? Then maybe we can have a chat about that. But for me, I don't see any significant moves coming anytime soon for this one. Anything else before I end? Okay, yeah, quick look at yields just to show what we were watching yesterday, or what I was watching yesterday. Oh, let's come in a bit further. Go on an hourly. There we go. So 420 couldn't really get up there yesterday. This is becoming a bit of a level up here, and then we had the little collapse in yields. Again, it sounds like a broken record, but I don't see reasons why yields should collapse at all. The fundamentals don't say they should, but I see a case for yields moving higher, but that's going to follow the data. So if the data continues strongly, then the market's going to take yields higher because of that. Interest rates maybe staying on hold for longer than expected. Kay, did you want to, Mark, you got nothing on at the moment? Okay, mate, no problems. Lucas wants to take a look at gilts. Kay, you want to look at gilts? Do you want to look at your late diffs perhaps?
I haven't charted them, but I can pull them up. Yeah.
Yeah, maybe just the rate diffs or something. Whatever floats your boat. All right, let's pass the buck.
I'm going to take while I'm loading up the screen. I'm going to take Peter B's question around debts and deficits and stuff. I suppose I can call you Peter. Let me see. Okay. Oh, oh, there we go. Because the debt is 34 trillion, do you think the dollar will go down? That's a question that I've heard for 40 years. Since I started in banks, it's been a question about debt. We also know that it's really started to it started really since markets started, but really 70s, 80s, we already started to talk about debt, and it's roaring its ugly head every now and then. But I'm going to say the more accessible information getting much more accessible, people have a lot more comments about that as well, and there's a lot going on. There's a lot going on about deficits, debt, and people fiat money going down under. I don't think that during my rest of my career, or perhaps even life, we are going to find a solution, nor markets going to be completely dismantled because of deficits. We have seen in the past that there's always rescheduling. Yes, there is and it's going to continue. The certain layers of the economy are going to suffer from it. But are the markets going to take the dollar down? Because, and to go specifically into your question, because of 34 trillion debt, we'll trade some of it when the big boys will decide to trade it. But for now, they haven't traded it. I think it may actually be even more a problem for other countries who have been issuing a lot of dollar debt over the pandemic as well. And when those things will come to maturity, we may first see an issue over there rather than in the US. I'm not saying that the US has it all under control, far from, but to put a trade on because of debt in the US is either you have a very, very long-term vision and you think that it's going to weigh on assets, which is, if you look at the equity markets, not at all the case. If you think it's going to have a very long-term impact, you can perhaps think about it, but then also think what if you want to go short dollars, against which currency you are going to put it in. Because if we bring it back down to the shorter term, we know that all central banks are reading from the same handbook right now, and I really, this is something that I'm more than happy not to trade, really more than happy not to trade. It's coming back. It sometimes has an influence on bond markets, but then again, look at what's happening in the rest of the world. If the US has a problem with its deficits, look around the globe and you will see that other countries may be running into trouble much faster than the US. And let's not forget that over the decades, a lot of debt gets restructured and even forgiven in some cases. So to me, for what I'm trying to do, and even if let's assume that we're doing medium-term trades, that is like within the 1 year or so, it's something that I'm not trading. I'm not trading unless it's becoming really an acute problem. Okay. That for that. Aussie, yeah, we've been looking at this level, right? We've been trading off it on both sides. I'm trying to trade off it again, seeing if it can cap those levels here, this 25.40. We did get back above 65. We in line with the rest of the dollars. It's moved up again, but now let's see that if we keep it. I think we are possibly changing ranges a little bit on quite a few currencies, but undeniably it's going to take flows. And for the time being, I've got the impression that there's a lot of short-term positioning going on. Call it hedge funds, call it some other players like the intraday players also. But if we would see real money taking a big punt at some sort of direction, we're going to have to see these kind of levels come up and then start to really push lower. That is, if they're really in it, or if they want to take on fresh positions in the dollar as well, in general, this one should find an offer here and then start to drift lower again. And my question is, do we really see big flows in this market or real money flows in this market, who are really the drivers of markets? It's not us. It's not the intraday. It's not the intraday hedge fund community. If they're playing intraday, that's not the guys who really make a market move decisively. Real money is, and for the time being, those kind of moves don't give me the impression that there's a lot of real money involved. You will see if, for instance, it caps here and now it starts to go lower, then it caps again here and starts to go lower. That may be the indication, okay? And that's sort of what I'm looking for in this zone. But if it goes above here, I'll be gone. I'm not even waiting for this zone here. If it goes above here, that means that the short-term community has traded the FOMC, has traded the NFP, has traded the PMIs, the ISM and stuff, and now is looking for clues. Okay, and the same thing on the euro dollar really is happening. We have seen this move, and we spoke about these levels, right? The prior low here, 107.23, 24, tagged several times, and we're bouncing. Okay, we are not even going to test the 107.15. But now, if you look at this little level here, 107.80 already, okay? 107.80 to 107.95, I would say. If real flows are in the market, I'd say this should not trade back above 108, okay? You have, same as in the Aussie, you have the NFP, you have the ISM, you have the FOMC flows. This should not trade for the short term above 108 anymore. Okay, one could already argue that the levels where we are in here should cap a little bit, but you always have to leave a little bit of leeway for short termers to get taken out of positions also. But now we're looking for the indication that it comes to the back to 11 and then goes back down. All right, that is what we are just waiting for. All right. And then quickly on Ali, and Ryan spoke about it, I find this euro sterling coming back down relatively easily. Okay, yeah, we had this couple of days of moving back up, a bit of euro process as well, moving back up, and then it comes back down. And Ryan already showed the cable from where it bounced. It does look like the sterling still has this little bit more. And I call it elasticity in what it's doing. That meaning, like, what I mean by that is the capability of bouncing. And sterling still seems to have it in it right now. Okay, so that is what I'm thinking about the sterling, and I think it's not out of the question that we are going to test the zone. A lot of people are watching this. There's so many eyes on this zone is going to be peak, right? So we can expect more bids in there from people who are perhaps short, and but if it goes for the break, it may be a fast one down to low 84s, as we have been already showing before. Okay, we need to look at it. There's an ongoing joke in our chat room that we are not talking about the Swiss franc, because most of us are short the animal, thinking that S&P's dollar and Swiss franc should gradually weaken. I'm completely in that camp as well. And as I said a couple of times already, we are going to need help from the Euro Swiss, because that's been a weak little brother in the whole thing, and it is showing that it finally wants to get going again. All right. And what we have seen after the release of the FX reserve this morning is that the Swiss franc indeed found some offers, and we are trying to push a bit higher again. And then but what we also saw is that yesterday we capped at the top end of the daily cloud, also at the top end of the latest move. All right, so this we are turning around again. This is really what's going to have to break and hold on a daily close, in my opinion, to continue to go. Okay, we had a retest of this little trend line, went back below 38.2 here. Is holding right now, and it's looking okay, I would say, for this move. All right, same thing happening in the crosses. We've got sterling Swiss that is now trying to break above the 110 again. We had a pretty decent hold here the day before yesterday, back around 109, and it's looking all right. And that's perhaps one of those currencies that's holding the sterling actually up as well, because when nothing else is going on in markets, some crosses can just be a driver of what's going on in the currency, just full stop. And this may be what is also holding the sterling up right now. This is this sterling Swiss. All right. Little mention here on the dollar Mexico. We're back at 17, and it seems to hold again. Okay, people are looking at this. People are really looking at this support here in the 17 zone. It's holding, as I was saying yesterday, also on phase. This is really starting to be not only a technical, not only a very high yielder. Why MEX crosses are still doing relatively okay every time we see a bit of a Mexican peso sell-off, but it's starting to be a political currency, right? So we have seen on the Trump victories, we have seen the MEX lose steam because we're talking about walls, we're talking about immigration again, and going forward, this is going to be something that you need to pay attention to. I'll talk about the MEX perhaps a bit more tomorrow, because we have Banxico as well tomorrow, all right? So we'll talk about the mix a bit longer tomorrow. Bran, you told me years ago that to watch Euro Swiss to watch dollar Swiss will do, or where the flow is going. I don't know if that makes sense. Yeah, I mean, there's the thing. That's what I was saying, Bran, right? We need help from the one or the other currency. And the thing is that being such a close neighbor, and obviously trading partners, and that's something that people who are trading Swedish krona should also bear in mind. Europe being the biggest trading partner, so you have to look at what's happening in between the biggest counterparty of one currency to get a good feel about what's happening globally for the currency, and that's why, even without necessarily having a position, that's why I'm looking at what's happening in this Euro Swiss cross to complete my idea about or my bias, or to know what's going on in the Swiss. Okay, you really need to look at what's going on in the Euro Swiss for that. And if you want to trade dollar stocky, you have to know what's going on in the Euro stocky as well. Ryan, I think I've taken enough time today, and I'm giving it back to you, mate.
Thank you very much, mate. Right, just Ali and his dollar yen. You're long. You want to ride this trade if possible? Yeah. Well, you obviously in the money. Was it 147.94? You're long, so you're there or thereabouts. You know, we have found a bit of support around 70s.
You're not sharing your screen, Ryan.
No, I'm not. I'm not.
Okay.
Let's fix that. So it might make it a bit easier. There we go. 149s. I don't know about that, because if you get 149, if you can get through 148.80, most certainly. But for now, I think you need to keep, if you're trading this on the long side at the moment, you need to keep an eye on what yields are doing. If US yields start creeping back up again, then you can keep riding this. If they don't, then you've got to be a bit worried about it and whether it can continue. But, you know, you're working the right way at the moment. I see from some of the other trades like your euro sterling, you're taking profit when it's there, locking that in, just follow up with your stops. As long as you're getting your risk to at least break even. So if you get another 10, 20 pips out of it, you decide to take profit, then you can bring your stop up a bit, maybe to entry or just below, just to get that risk to zero. And it doesn't matter. If your risk's at zero, then it's a free trade, and you've got no pressure on you to do anything. Same for euro sterling. You're short 85.60s. Well, here we are. We're down at the support and we're having a go, but we're not getting through it just yet. So you know what to do. You've already taken some profit. So, you know, look at where to bring your stop down now, perhaps. We know it's resistance up here at 70, but you can maybe look, if you want to, just start bringing it down a bit, protecting what you've got from 60s to here on the rest of the trade, and just manage it that way. And if it doesn't break, if it doesn't go lower to 85.02, if you get another test down here, then you've got to ask the question, do you take a bit more off? Again, just put more in the bank, and perhaps leave a little bit on the table just in case it does keep going. But it's all about protecting what you've got in trades like this, and then worrying about making more on top. Cool beans, Ali. Good luck, mate. And to everyone else, trade safe. Thank you for coming to the Flow Show. Have a great day. Make lots of pips. Let us know about it tomorrow. And also let us know if you want us to talk about other things on the show. You know, we're getting a few chats from you guys, but we want to hear a lot more from you folks. So anything you want to hear about from us, let us know in the comments tomorrow, or reply on our tweets and whatever, and we'll make sure we get those covered. Cheers, Kate. Thanks a lot, mate. See you all tomorrow.
Everybody. Thanks, Ryan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.